All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Let's go out and take a look at several things here this morning. But before I do that, I will not be on video this afternoon at the normal time. I will be away at that time, so I won't be able to access video. If there is a trade signal that comes up, I will trade it, and a trade alert will go out, and the spreadsheet will be updated. But there just won't be video. Everything else will be normal. There just won't be video. I will record the trade just to be able to post later, just to verify that it is a live trade, and the fill price and all that kind of stuff with real money. And we'll post that probably this weekend if that happens. Now, I don't expect a trade to trigger here this afternoon, just kind of looking at way things are right now. But again, everything could change, and if something does trigger, I will go and jump into it. We may also be in a position here this afternoon where I need to take off Boeing because Boeing here is coming into its auto exit date here this afternoon. Now, it's its auto exit date if the option is red. And this is one of those that's a little bit ambiguous because, well, overall the option's very green, right? If we take the original entry. But if we take the re-entry or the trim area, the option currently is red by about $100 here. 12.15 is the mark. So let me put that in here. So we're slightly red, and again, that does leave a little leeway there. If it's just a few bucks here or there, but it's down about 120 right here, and most likely would be taking it off here into the close if it is still red. And so I will still have the alerts go out and everything else. I'll be able to put some chats into the message feed as well, but I just will not be on video here this afternoon. Okay. All right. So anyway, that's pretty much it for the challenge this morning. There are no new signals out there. It's dry. It's just one where we looked at it yesterday. Most stocks just aren't in a position to signal, and some of the ones that were, like a Verizon, didn't get a signal to the downside. Still not getting a signal to the downside. Some of the banks, didn't get a downside signal yesterday. Still not getting a downside signal today. As these are some of the stocks that are kind of holding up nicely. Twitter, same thing. Didn't end up with a downside signal. It's bouncing a little bit here, but for most stocks in the watch list, it's going to take a little bit to to get them to signal or to trigger here in the next at least for today and probably Monday. But there are a few that could definitely switch a little bit. Altria, MO could easily switch here. We could see something with J&J. There are some that could, but nothing happening there this morning. So in Boeing, and still running here with Boeing, would sure be nice to see it, kind of have a yesterday afternoon rally in it, and see it push up over the 375 mark, be able to take it into the weekend, and especially with some of the conflict going on in the Middle East, and some of the trade talk and everything else, it'd be nice to have a little bit of upside exposure going into the weekend. But again, that's not going to be my decision. That will be the algorithm here that really determines it and where it sits. So anyway, that's the challenge. Easy peasy. There with it. Now, I promised I would show the 3-7 scan here this morning, and I'll show you two scans with it. One with the 3-7 crossovers just for the challenge watch list. And these are the bullish crossovers, and you can see Target on this list. And this is kind of what it looks like right here. This could potentially be a signal by the end of the day. It's not even close to a signal right now. in terms of the consolidation risk, and I really don't expect that to change. But does have that 3-7 crossover action, to the upside on it. To the downside, let me show you kind of the downside here. This is just 3-7 crossovers. These aren't stocks that are triggering for the challenge. But here's Micron, and this one's selling off a little bit more here today. We talked about this one having the potential to trigger on the downside if it weakens, and it's definitely sitting in a place where it could be a downside trigger here this morning. The consolidation risk just a little bit high on it, but we could easily see that switch here by the close today. You know where I stand with Micron overall, and this is a stock I do think has a risk of going back below 20 here this year. And that's a big move from here. But, we talked about that up here when Micron was 40. And it's not going to take much to see further selling here. It's a stock I'm pretty comfortable is going to go lower. What I'm curious to see is how the algorithm triggers in terms of the probability of moving two average true ranges here, which is about $2.60. So that would mean what's probability of it breaking down towards 30. Which is kind of what we would need to see be elevated to trigger here for the challenge. So anyway, those are the scans here for the challenge. If we come in and we just take and go S&P 500 on the watch list, we do have a few more kind of going on in terms of crossover action. 22. I'll show those to you here. A lot of them in the real estate sector. You'll notice these are safety sectors: healthcare, real estate, consumer staples, utilities. Those are the ones with the downside crossovers today. Right? It's it's one where there's just not a lot here with them. Or excuse me, these are. Sorry, I misspoke there. My apologies. Let me go and show it here. But here's like ABBV, has that downside 3-7 crossover here today. Pretty ugly chart, and suggests lower, but again, those are the 3-7 downsides. On the upside here for the S&P 500 stocks, we have a few. Western Union, Union Pacific, Target, which we already saw, Norfolk Southern, so a few other railroads coming into here, a few financials coming into here, but pretty light list. Pretty light list here for the market as a whole. All right. So those are the 3-7 scans. Now, last night, we had more talk about Iran and what's going on there, and how things are transpiring when it comes to U.S. President Trump possibly retaliating, and we have Democrats yapping about it too, and it's a political thing. It's a geopolitical thing. There are a lot of elements there, and it's one that the markets aren't reacting to in a big way yet. We could see them react. It does look like, Iran is intentionally kind of poking the bear a little bit. And look, they have every incentive to, right? When you think about their incentives, you think about it from a game theory type standpoint. Look, since Iran kind of started, with some of that sabotage in the Gulf of Oman, oil prices have changed dramatically. And they absolutely need oil prices to change dramatically. And so, we see that happening. Do they have any incentive to let off? No, they don't, right? So the more they can poke, the more they can prod, the more kind of consternation they could cause without taking the risk of, full-blown war. It's in their self-interest, and that's not going to change here this weekend. That's not going to change next week. That's not going to change this year. So it's going to be an ongoing situation, something that both sides of the U.S. political aisle will have a lot to say about. But again, we'll see kind of how that plays on out. But we do have that going on out there today. Okay. Now, this morning in the morning note, I mentioned that the market yesterday hit a new high, and I'd go out and talk about it. And I put in some of the negative headlines that we are seeing out there in the market. And it has seemed that this is a very negative rally in terms of sentiment. And I went out yesterday and kind of looked a little closer at some of the metrics and some of the data. So I kind of want to speak to it. All right. Now, anytime I speak about the market, it is something that I always worry, and because it happens that it's taken out of context. Okay. I'm going to talk here today about some of the longer term elements of the market, not about what it's going to do in the next hour. Right. Not about what it's going to do next week. If you want my just full take on what I think of the market right here, right now, it's over here on Trader Minute Academy. It's the market vibe. It's still bullish. I'm still bullish. Great. All right. That's it. It's that simple. As long as these metrics stay bullish, I'm bullish. And yeah, we can pull back and anything like that. But, I'm not in the business of trying to predict a pullback. I'm more in the business of reacting to when it starts, right? And the market vibe does a great job of showing when that starts. And, we saw it trigger bullish, the day after the low. And, the market's been going up ever since, right? And even on a few of the down days, market vibe has stayed positive and market continues to go higher. So that's my take on the market in terms of, where's it going right now, path of least resistance. But if we go out and we take a look at some of the longer-term factors and the possibilities going forward in the market, right, especially from an investment standpoint, and I'm going to come in and just pull up a monthly chart of the S&P 500, and I'm going to get rid of all of our indicators, right? But here's the S&P 500, and it's going to 3,000. Right, we're going to hit 3,000. That's the market's gonna chase after. Right, market's gonna party like it's 1999 according to some of the headlines, and we're going to see the market chase to 3,000. Okay, at that point, we'll probably see a day or two pullback. We could see something a little more substantial, but this is one of those scenarios and one of those situations where the question has to be asked. Okay, market path of least resistance from here over the course of the next several years, higher or lower, right? It's easy to talk, well, the market's high, it has to go down. But we know that is the most flawed methodology and mentality out there in the market. Stuff that's down doesn't have to go up, and stuff that's up doesn't have to go down. And we saw in 2013, 2014, market's making a new high, it has to pull back. No, it doesn't. Right? Finally gets a little pullback and, all right, goes off to a new high. We've had a few pullbacks, since, and here we are sitting at a new high. So can it go on higher, right? Normally, new highs are accompanied by this kind of sentiment of, hey, everybody's bullish, everybody get in the pool, everybody let's go. And while some of the headlines suggest that that's what's happening, that isn't what is happening when we go and we look at the sentiment indicators. There are two things I want to show you. I want to show you the number of stocks making new highs, new lows from a technical standpoint. Then I want to show you a sentiment standpoint right now. So let's start off with the new highs versus new lows in the market. Just the number of stocks, creating new highs versus the number of stocks creating new lows. Something happened this week that was very interesting. Is yesterday we saw the number of new stocks hitting new highs reach up to almost 500. You say, well, what's the big deal? 500 more new highs than new lows. What's the big deal? When we saw the pullback, there were 200 more new lows than new highs. Back here in December, it was minus 1,200, so a lot more new lows than new highs. What's the big deal about new highs here? Well, if we come in and put a little more time on this chart, okay, I'm going to do two things. I'm going to come in. I'm going to put a 10-year chart up, okay, and I'm also going to put an indicator on here called price. Right? I just want to see the price of the market, and let's take a look. Here we are in 2011. A lot of new lows. We had the flash crash in 2010. This is the European, debt crisis. Things are going to, fall apart and down they go, right? And we have a lot of new lows set here. And then we get into this period where we start setting a lot more new highs, right? Here at the beginning of 2012. And then we get this kind of later on rally where there are even more new highs. Look at the number of new highs, 800, right? And yes, the market pulls back from that point, right? We get a few kind of nervy moments in the market. This was actually set on the Fed. This number of new highs set on some Fed action, some QE action. And there was a little bit of pullback. But take a look at what happened in the market overall, longer term, when there were a lot of new highs set. What happened? What's the path of least resistance? It's significantly higher. Once we start to get into a period where we start to get more new lows and fewer new highs on rallies and more new lows on sell-offs, that's when we go into consolidation and pullback. Then here in 2016, you'll notice here we are, big new lows, but take a look at the new highs that start to come in here in 2016. They're more than in 2015 or the end of 2014. We start to get into an increase period here, right? Similar to 2012, an increase period. What happens to the market after that? It goes significantly higher. Look at what's been happening recently in terms of the new highs versus new lows. The new highs have been getting less and less and less, and this is one of those arguments that I brought up, many times over the last couple of years. Of hey, you know what? When there's a sell-off, it could be pretty harsh. Why? Because you know what? We're just not seeing the same number of stocks participate in the rallies. But there's something really interesting about this year's rally. Despite all the kind of bearish sentiment around the rallies, we actually have the number of new highs starting to increase the way they did in 2016 and the way they did in 2012. Now, keep in mind, 2016 and 2012 were not smooth, easy, straight-up years, but the years after were. The years after were pretty darn bullish. We have seen this market come in and set more new highs than it has since the beginning of 2017. And that was on a period where we started to kind of see fewer and fewer. But, in this really nice kind of bullish mode. But the last time we've seen new highs increase like this, 2016, 2012. That is something that, for the bears have to keep an eye on. Because when you look at markets that start to print more new highs than new lows, they tend to be very bullish markets, not bearish markets. Okay? So that is a big change. That is something that is very different right now. It's happening at a very interesting time of the year, and it doesn't mean the market can't pull back, but it means something else is going on that has to be looked at to say, okay, why would things continue to go up? The one thing that I'll continue to stress, we talked about this, on the last little market pullback. Stocks can go down. But you think about central banks around the world and what they've done. Lowering rates and lowering rates. And look, the Fed is going to lower rates. And, according to some, they're going to take them down to zero. According to others, they're going to go into quantitative easing. Where I stand, I talked about that yesterday. But the Fed has effectively killed the bond market for investors. Bond market just doesn't pay. Yeah, you can trade the bond market, but are you going to allocate, huge amounts of money there and expect the same type of returns as years past? Not at all. So you have to start getting into stocks. And, with the Fed doing what they've done over the last 2 years in raising rates, they've kind of made the bond market a little bit more attractive, albeit, not all that much more attractive. But now with them lowering rates again, what are investor options? It's not stocks versus bonds anymore. It's not, hey, everybody in the stock pool or everybody in the bond pool. It's what? Oh, okay, we're going to go buy utilities and high dividend stocks, or we're going to go buy, industrials. Everybody out of industrials and financials, let's go into utilities and dividend names. Okay, everybody out of dividend names and into industrials, right? The flows of money are staying within stocks. They're just going between sectors. And the sector differentials that we are seeing in the market are historically high, meaning the performance of certain sectors over other sectors, from period to period, gets to be pretty high. Take a look at the tech over the last 6 months. Tech, 33% gain. Here's utilities and healthcare, 12%, 13%. Tech has been the big boomer here, right? When we've seen the market go into pullback periods, this has changed, right? This element of utilities versus tech has changed pretty dramatically. And in fact, here of late, we've actually seen, some money going into utilities and out of tech. But this week, we are seeing what? The money rotate out of tech and staples and rotate into rotate out of utilities and staples and rotate into tech and industrials, right? This idea that, all this money has to come out of the market or into the market, that used to be because of the bond market. Money went into the bonds, money went out of the bonds. But most investors are not in a situation where they can be in cash, in huge amounts of cash, because cash, aka bonds, do not pay. Just absolutely doesn't pay. So they have to rotate in terms of where their exposures are in the market. What does that mean? That means there's less money to come out of the markets. That means as money comes into the markets, right? New money created, which we see month to month, new money created, it naturally is going to push markets higher. This isn't something where we go, there's a bubble and there's a big alternative over here in the bond market to now take all your money and go put it in. So we're going to have to see some economic catastrophe to see investors or major money managers go, you know what, I've got to just take all this money, and I know bonds don't pay, but I got to go put it in there because it's better than losing huge. We're going to have to see a really big downside catalyst to get that to change. This is different than what things were in 2007 and 2008. You could rotate into bonds and actually get paid a little bit. Not anymore. And it's not just not anymore here in the U.S., it's not anymore around the world. What, in Japan, you're going to go buy some bonds and actually pay money to have your money in bonds? Is that what you're going to do? No. Central banks, they've effectively killed that rotation for a large part of the market. So this isn't a everybody in the pool, everybody out of the pool. This isn't a, hey, we're partying like it's 1999, buy anything and everything and it's going to go up. No, the market has been incredibly more sophisticated than that. The amount of information, the amount of technology, the amount of data that the market has today versus 1999 is incredibly different. The savviness of investors is incredibly different. Now, we're all human. Humans, they don't change over time very much, right? But this idea of, well, you know what, things are just too euphoric and have to drop. Really? Really? And, with the effective killing off of the bond market, are we going to see it just be one of these things where, we go into a 2-year bear market and stocks are going to drop 50%? We could, right? The U.S. could launch a nuclear bomb on Iran, and Iran could fire a nuclear bomb missile back, and yes, markets are going to go down and they're going to collapse. But that's the type of thing it's going to take. It's not going to be because of weak economic data that markets are going to collapse. Weak economic data will create rotation, right? It'll create some pullback, right? It'll create some pullback. The normal 5 to 7 to 10% corrections are always going to be in play. But I think you can make a very decent argument that the Fed has killed the 30% pullbacks in equities. And some will argue that's a positive. Some will argue that's a negative. But, unless there's a massive catalyst, those are dead. What else are you going to go into? And just keep that in mind when it comes to the market. Now, normally when markets hit new highs, right? When markets hit new highs, the bullish sentiment is very high. You start seeing articles in the market that talk about, hey, everything's great, grand, wonderful, buy this, buy that, this stock's going to the moon, that stock's going to Mars. These are all going to, surge in a big, big way. Is that what we're seeing out there right now? Well, let's go take a look at 2 sentiment surveys. First one here is the AAI. You've seen me show this, American Association of Individual Investors, and they have a survey, the AAI survey here. And let's see here. I don't want all of that. Let's go back here to the sentiment survey. Okay. Historical average of people bullish in the market, 38%, 38.5%. This is for the week ending 6/19, so, Wednesday. 29.5% bullish. Significantly fewer bullish than the historical average. Also, significantly fewer bullish than what we see when markets make new highs. Normally, when a market makes new highs, people are overly bullish. Not underly bullish. Right now, it's under bullish. And I know this is just one sentiment indicator. Where are they sitting? Neutral. They're higher than average on neutral, right? But look at the bearish. 32.1%. The market making a new high, and the amount of people bearish is more than the historical average. Seriously? We have a market hitting a new high, and they're fewer bullish than normal, and they're more bearish than normal. You don't see this very often. We've seen it a few times historically. And when we've seen it, markets have gone significantly higher. You say, well, Jeff, this is just one indicator, one survey, right? And this is individual investors, blah, blah, blah. Yep, you're right. All right, so let's go take a look at another one. Let's go take a look at, and these sentiment surveys are out there. They're all over the place. In fact, Bank of America, Merrill Lynch, they published one this week, and it showed the same thing. Right, show the same thing, but let's come in here to economic indicators. I believe. Let's see, where do they have it? Sentiment surveys, and I'm going to come in here to U.S. investor sentiment percent bearish. Okay, and we're going to come in and let's get this over 10 years. And the bearish sentiment right now is 32%. Take a look at that historically. The bearish sentiment right now is significantly higher than where it was when the market hit the new highs this year, earlier. We're just sitting in a spot where the bearish sentiment is really high. It's one where we haven't seen that sentiment wind down, to a point of, hey, the market's overly bullish. If we back this out, right, I'm going to pull up the, maybe, if it'll let me back out. I may have to go back through this. Here we go. But we'll take a look at the difference between the bullish and the bearish spread, right? The percent bullish versus percent bearish, right? And let's go take a look at that, because that's a little more of a visual indicator. And let's just come in here. We'll go 10 years. Basically, we're at minus 2.62. Means we're more bearish than bullish. Are we in any of these periods of overly bullishness? No. We're in one of these periods where the bears are still more bearish than the bulls are bullish. Confirms what we saw on the other sentiment indicator. Confirms what we saw from Bank of America Merrill Lynch earlier this week. Why does the media have a whole bunch of bearish articles out there on days where the market hits new highs? Well, because most people are going out reading the news, they're looking for affirmation, not information, right? So they're bearish. They want to have their bearish bias confirmed, so they click on bearish articles. When the sentiments turn and get bullish, you see tends to be more bullish articles out there in the news media. Why? Because bullish people, they don't want the bearish argument. They want bullish arguments to affirm their conviction. So right now, we are sitting in a market that's basically hitting new highs, where the sentiments are not even near where they were right here in April. Right here in April, yeah, the bullish sentiments were a little overcooked. Right now, with the market back in the same spot, just slightly higher, man, it's a little different picture. And we just don't see this very often. And it's one of those, when we've seen it in the past, we tend to see the markets continue to go higher, and not by a little bit, but tends to be by a lot of bit. Right? Markets had a little pullback, it's had a higher low, springboarding up. Are there issues out there? Are there concerns? Are there things that could happen to change this picture at any moment? Yeah, you betcha. Right? I mean, we could see, China, U.S. this weekend at the G20. President Trump and the Chinese premier get into a tiff and basically say enough with you, we're not trading with you, period, and you know what, we're going to escalate some military tensions. Probable? No. Could it happen? Sure. Would that change things dramatically? You betcha, right? But as we look at things where they sit, when we look at the metrics, they're overall very bullish. When we look at the sentiments, they do not match the metrics. The sentiments are more bearish than the metrics, and we haven't seen the sentiments catch up. And normally, markets top out when the sentiments have caught up and gone too far. What's it going to take for the sentiments to catch up and go too far? It's going to take a significantly greater market rally, not just here in the U.S., but around the world. So hopefully that helps in terms of, kind of understanding, where some of the things in the market are right now. I know that, kind of going out there and some of the news articles and everything, there's a lot of fear mongering, going in. We have Peter Schiff and, some of the perma bears, who are always bearish and, always talking about a big collapse, starting to really chirp up here right now. And, I know that can kind of create some anxieties and everything else when it comes to trading and investing. But, for the most part, right, things are not different, right? Things are not different. Things remain bullish. And, yeah, the earnings story, there's some trouble on the horizon. The economic data story, yeah, there's some trouble on the horizon. But you know what? The market has its little blue pill. It has its Fed in its pocket, and we've even heard Fed here this morning. One Fed governor came out and said they were in favor of a 50 basis point hike this month, right? And the Fed is kind of tooting that, hey, we're dovish, we're going to cut rates, torn to kind of placate the markets, even with the markets at new highs. It's a new day. This is not 2007. This is not 2008. This is not 1999. This is not 2001. This is not 2004. It is a different Fed. It is a different global dynamic in the markets, and it is a very different stock and bond market, and one where there are plenty of catalysts to send it higher. Think about the wall of worry right now. The wall of worry is very high. And normally when tops come in, the wall of worry is pretty low. Thanks for hopping on. Have yourselves a great day, and we'll talk to you later. Take care.